Today, I want to analyze one of the most misused areas of interest in smart money, the rejection block. The goal of this video is not just to show what it looks like on a chart. I want to analyze when a rejection block really gives an advantage and when it turns into an ordinary zone from which the market can easily move on. Because the rejection block becomes strong only under certain conditions, when it's in the right place within the scenario and is confirmed by what the market has already done before it. We will also talk about how to work with the target when trading from a rejection block. That is, where the market can logically take the price after it has rejected and changed the flow of orders. I'll show this with different examples so that you can see how this logic repeats itself, even when the instrument and time frame change. Before moving on to the examples, it's important to clarify what I consider to be a valid rejection block. Rejection block is a rejection zone that forms at an extreme after liquidity has been taken out and the order flow has changed. Remember, a valid rejection block only exists after liquidity has been taken out. The market goes beyond the already formed maximum or minimum, takes liquidity there, reacts, and goes in the opposite direction. The area where this rejection occurred is the rejection block, the place where the volume entered the market, breaking the current scenario. Why does this happen at all? And why is this zone important for big players? A high-volume trader cannot simply press buy-sell anywhere. His volume alone shifts the price. So he needs liquidity on the other side, that is, a cluster of stops and pending orders that will be accepted by the market. When the price goes beyond the maximum or minimum, stop orders, limit orders, and stop limit orders are triggered, creating a moment when a large participant can sell their volume at a favorable average price. Taking liquidity gives him a flow of opposite orders. Once this volume has been tapped, there is no longer any need to keep the price moving in this direction. And when the price returns to this area, it's not just a level. It's a point where the market has already shown once that it was profitable for a large participant to defend their position here. Therefore, if the context has not changed, it's logical to expect a repeat reaction from this zone. It's important to understand that a rejection block is not just any candle with a tail. It only makes sense when several conditions are met. First, there must be clear liquidity before it, old high-low, equal extremes, session highs-lows, PDH-PDL, and so on. And the larger the liquidity pool that the formed rejection block takes, the stronger the potential reaction. Second, the market first tapped this liquidity. It goes beyond the extreme, takes the pool, and only then gives a reaction. Third, the candles that form the rejection block must be at the same opening level. There are two types of rejection blocks based on the direction of movement. A bullish rejection block is formed after the sell-side liquidity is withdrawn. The price goes below the previous lows, executes stops and pending orders below the lows, then gives a strong upward reaction and triggers a shift. The zone where the market stops accepting sales below and switches to the buy side should be marked as a bullish rejection block and used as an area of interest for long positions when the price returns. A bearish rejection block is formed after buy-side liquidity is withdrawn. The price rises above previous highs, takes out stops and pending orders above highs, gets rejected from moving further up, and begins a downward shift. The area where the market stops supporting buying and switches to the sell side should be marked as a bearish rejection block and considered as a poi for shorting on a retest. Now, let's move on to the chart, where I'll show you how to use the rejection block in practice. We will analyze several different situations to clearly see under what conditions this zone really works best and how to work with it correctly as a zone of interest. First, on the higher time frame, we see a large pool of liquidity being withdrawn. The price aggressively moves up, taking the buy side, and forms two candles with openings at the same level. One of them gives a clear tail towards liquidity. It is this one that executes the main pool, after which the price immediately returns back. In this configuration, for me, this is a valid rejection block. There is a withdrawal of liquidity, there is a refusal to continue the movement, and there is a change in the flow of orders. I mark the zone by the wicks of this candle and use it as the higher poi. Further, since this rejection block meets all the criteria, you can switch to a lower time frame to find a more accurate entry area with a short stop. As of today, we already have a target, the maximum liquidity of the London session, and above it is our area of interest in the form of a rejection block. During the New York session, the price first takes out the intraday liquidity of the current day again, then enters the rejection block zone and immediately reacts. This can be seen from the pronounced shadow of the candle from the higher poi. After such a reaction, it is logical to open a trade with the goal of taking out the liquidity of the Asian low. In this way, by synchronizing the higher and lower timeframes, you can not only mark the block, but also use it for a more profitable entry. with a clear logic of the target. Now let's look at an example where the scenario is based on the withdrawal of yesterday's liquidity. The chart shows how the market takes yesterday's PDH. The situation is very similar in structure to the previous example. Again, there are two candles with openings at the same level, and the withdrawal occurs not only at the day's high. The London session additionally takes out liquidity from the current high of the Asian session and forms a rejection block there. That is, we have several executed pools at once, yesterday's high and today's high. Next, I switch to a lower time frame. There you can clearly see how the price is aggressively delivered to the rejection block zone and touches it with the shadow of the candle. For me, this is a signal that the market respects this area as a zone of interest. Liquidity has already been tapped. There is a rejection, and there is a reaction. In such a configuration, it is logical to open a trade with the aim of withdrawing the liquidity of the Asian session low, because this pool becomes the next obvious target after the reversal from the rejection block. Now, it's important to understand that there are actually many similar situations on the chart. And here there is one common mistake: trying to call any area that looks similar a rejection block. If we take an invalid rejection block, for example, as in this case, where the block is not related to liquidity withdrawal at all, we can see that the price simply ignores this area. There is no tapped pool, no rejection, no change in the flow of orders. The market moves on, and such an area doesn't give any advantage. Please note, in all the examples we have discussed, the rejection block never exists on its own. In addition to the block itself, the entire logic is always tied to sessions and liquidity within the current day, the Asian range, the London high-low, and the New York session. When you test this zone of interest on historical data, I recommend checking 3 things each time. First, what liquidity pool was taken out before the block was formed? Second, during which session did this happen? Third, what is the next logical liquidity move the market can make after the rejection block reaction? If you still find it difficult to understand liquidity, session logic, and working with zones of interest, you can simplify the task and use the owl indicator. This is not a smart money tool and is not about liquidity. It's a standalone trend indicator that immediately takes into account several timeframes, Fibonacci corrections, and shows ready-made levels for entry, stop, and take. It's suitable for those who are still gaining experience and want to trade according to clear, structured rules without trying to keep the entire market context in mind at the same time. You can find a link to the indicator in the description below the video. For those who trade crypto, this logic also works. Rejection block in the crypto market is formed according to the same principles. First, liquidity withdrawal, then rejection and shift, and only then, retesting of the zone. The only thing I don't recommend is to get too hung up on the logic of sessions, as you might do with Forex or indices. Crypto is not strictly tied to London and New York. Movement can start at any moment, so the context of the higher time frame, liquidity pools, and how the price reacts to zones of interest are much more important than the time at the terminal. If you trade crypto, it's easy to do so through Evedex. It's a decentralized exchange without verification or unnecessary restrictions. Just connect your wallet and you can immediately start working with your scenarios. The interface is simple, execution is adequate in terms of speed, and commissions are not high, which is especially important for those who trade crypto with leverage. I'll leave a link to the exchange in the description below this video. In this video, I wanted to show how to work with the rejection block zone of interest correctly. But the most important thing you should remember from this is that any poi on its own is meaningless. No rejection block becomes a strong zone just because it looks nice on the chart. There's always additional logic. What liquidity pool was taken out before the block was formed, in which session it happened, how the market behaved after that, where it could logically take the price next. Rejection block is just one link in the chain. First comes liquidity and context, and only then the execution zone. If you perceive it as part of the scenario rather than a pattern, it will really start working for you, not against you. If this video has helped you look at zones of interest and the logic of large players in a different way, please support it with a like. And if you want me to analyze other pois in the same format, write about it in the comments. Work with context, understand why the market is entering the zone, not just where it is. And then the rejection block will become a tool for you, not just a picture.